Only the lonely know the way I feel tonight.
Hello everyone, it's Gene Ahrensberg with Got Gold Report. It is Sunday, April the 21st, 2012. We're in the midst of what I'm convinced is a slow motion capitulation in the small, less liquid, and more speculative resource-related issues we like to game here at Got Gold Report. And I thought I'd take a look at some of the issues we already have positions in, just to touch base on them and let the members know what we're doing. While we're here on the blog, if you haven't already, you might want to catch the video posted on the front page for a setup for today's member video. We talk about one particular issue in that public video, but today we're going to cover quite a bit more ground, and we're going to do it in kind of a quick fashion. Just remember that everyone can hit the pause button if they need to study the picture or the chart. So let's get started. When the market is bleeding liquidity in a relentless fashion, like it has been for the exploration companies, we vultures have too many opportunities to take advantage of all of them. It's time for a little vulture bargain triage. To give an idea of what we're talking about, let's look at the chart for the GLDX, the Global X Gold Advanced Exploration Company ETF, which trades on the NYSE. Pretty ugly, huh? If anyone doubts that the companies we call the little guys have been under pressure lately, and few could doubt it, but if they do, just take a look at that wicked-looking picture. The GLDX has been cut more than half just since September of last year, 2011. This ETF has been bludgeoned for a sickening 44%. So in 7 months, the GLDX has plunged 44%, or about an average of 6.3% per month. That's the bad news. The good news is, at this pace, the GLDX would reach zero in less than a year. And I don't know anyone who thinks this index is going to zero, even if people are acting like they think it will. We have a world-class negative liquidity event underway again, and when they show up and persist for a long period of time, we can see some weird, ridiculous, stupid, cheap bargain prices and on not really all that much volume. In fact, low volume is one of the hallmarks of these low liquidity periods, and it's one of the things that gives me comfort. It means that we're in a buyer's strike, not a panic exodus of the sector. That idea is kind of our anchor. In January we saw volume picking up and looking better, but since then volume has fallen off again. It's a buyer's strike, an absence of buying interest as opposed to a large volume exodus. The smaller, less liquid, and more speculative junior miners and explorers have once again fallen out of favor with investors and the hot money crowd, and we're still in the midst of a negative liquidity event. More wealth leaving the market than entering. A falling tide, if you will. That's the bad news. The good news, as we can see from the CDNX chart, these periods of negative liquidity are always temporary. So we have the reasonable expectation of a reversal to come. We just can't know when that will be in advance. Here we are back on the Vulture Bargain member pages, and we're looking at the candidates of interest charts. Our job as speculators, well, a part of our job, is to identify promising issues that have been beaten up and then to build the largest nominal share position we can with that issue at the lowest average price we can within the limits we set for ourselves, so we don't go overboard and take too much risk. And then we hang on with both talons until the nasty negative liquidity and buyer's strike is completely over and the smell of greed is in the air. It's a simple theory, but it can be extremely difficult to implement. Vulture members will notice that we have yet to take a position in many of the Vulture Bargain candidates of interest. Let's click on one of the charts. This one happens to be Andina Minerals. First of all, we can see it's oversold in a big way, and it's in a cascade sell down, headed down into what would be our blue panic target for Andina. Now, as of right now, we don't have a position in Andina, but we are looking at it closely. Over to the right, you'll find our comments and the comments of others and the gurus that we keep track of here at Got Gold Report. Now, in this buyer's strike that's been going on since last March, Andina has traveled from almost $2 a share down to under 60 cents a share now. We think it could be getting close to a capitulation event, and it's already at stupid cheap and looks like it's heading for ridiculous cheap. This one looks pretty interesting from a vulture point of view. Of course, everyone needs to do their own full due diligence on any issue we track. Moving to a different chart, this is Guyana Gold. Now, depending on the pulse of the market, we use different buy targets for these guru chosen favorites. We don't have time for a full discussion of that topic today, but suffice it to say that in a positive liquidity environment, our targets to add shares are necessarily higher. And when the markets have gone liquidity vacuum crazy, like right now, we get to use our blue panic targets, or at least we think we can. Remember, the goal is to accumulate as large a nominal position as we can, and do so without going overboard and betting the ranch. Guyana is a good example of what has happened just since September of 2011, when it traded near $4 and now is down to about $1.75. Guyana is lucky. It's only been cut in half. But our targets are necessarily, at this time with the market so weak, quite a bit lower. We're looking to now begin building a position in the green if we can, and perhaps maybe even the blue. The market is certainly weak enough, and we could see a panic spike, kind of like we did with Guyana Gold, and we'll be talking about that in just a moment. So back to our little guy, Triage Idea. With only so much of our resources devoted to these highly speculative juniors, we cannot possibly build a meaningful position in all of them, not if we're using our own resources. So here's a quick fire drill on 5 that we are focused on. By the way, don't forget that you can always hit the pause button anytime in case this section or any section moves too fast. First up is Timberline Resources. TLR is in the area we personally believe is ridiculous cheap. This past week it traded all the way down to 42 cents. And we were on the bid for a small part of that at 43 cents, and we were able to get some. Let's look at another vulture bargain issue. Let's look at Riverstone Resources. Pretty nasty buyer strike. Look how Riverstone has traveled all the way from 77 cents down to the low 40s. And it's in the area that we would feel comfortable adding now, and who knows, we may even get a shot at the blue for Riverstone. I kind of doubt it, but we might. They've got 2.7 million ounces already proved up in Burkina Faso, 70,000 meters of additional drilling that they'll be putting into the next resource, and it's just gotten stupid cheap. Right, wrong, win or lose, Riverstone is one of the companies that we felt it was worth selling some of our gold to add to, and we will be shortly if it continues this plunge. Let's look at one more vulture bargain, one more fully fledged vulture bargain company. Let's look at the latest vulture bargain edition, Millrock Resources. And we had a great time with Millrock Resources in the 2009-2010 era. It literally traveled from panic-stricken 3 cents a share in 2008 or early 2009 all the way up to $1 and change, which is a 30 bagger if you were on the bid at 3 cents back in 2008. And since then we've been patient. We've been Very, very, very patient, watching it trade from $1 down to 1/3 of that turning high. And we kept our trophy shares from the original purchase, and we began adding again just recently, naming Millrock as a vulture bargain on March 22nd at 28 cents. It's a little under that today. But remember, 2 weeks ago we had that big large size seller come in all at once with about 300,000 shares, and we had a bid ladder set up, and we actually filled up our entire bid ladder thanks to that one seller. Remember that Millrock has quite a few kicks at the elephant country projects that they're working on in Alaska and Arizona, and it's well run. It's by people that really know how to find the big stuff. This is a company that could be in line for a major discovery, and look how inexpensive the ticket is today to play with Greg Beischer's Millrock Resources. That doesn't necessarily mean it can't get even cheaper. It can. But we have built a position that we're pretty proud of. Now let's take a look at a couple of vulture bargain candidates of interest. One that we would really like to take a position in is Attack Resources. The chart looks familiar, doesn't it? This was July of 2011, and here we are after being cut to a quarter of that price. Attack is still well above where we would love to take a position, but we're mentioning it now because it is showing a support break, or at least an attempted break. Fingers crossed for a low volume panic spike and maybe a shot to take a position soon. We might not get it, but in this market we just might. One that we have started taking a position in is Guyana Goldfields. Let's take a look. Guyana is the perfect example of disappointment selling, and it happens to be compounded by disappointment selling inside a major buyer's strike, a cascade sell down. It's got everything going for it for vultures. Now, we're still in the accumulation phase with Guyana. That first pass feasibility study, which disappointed the market, is kind of the toe stub that we wait for. But this is one that will be a mine someday, and those 6 million ounces are now in the panic target area that we think this is the panic area for Guyana Goldfields. We could be wrong. It could go lower, especially if the wheels come off. But my goodness, it was $8.60 here, and now we're down around $2.88 is the close. So it's getting to the really cheaps. I won't call it ridiculous cheap yet, but it's certainly stupid cheap by now. You know, at times like these, it's kind of hard to remember that volatility works both ways, especially with companies that actually do have interesting high-grade resources to work with. Right now the volatility looks like it's all down. It won't always be that way. And so our job is to build the largest position we can using the resources that we have dedicated to that particular issue. Remember, everyone has to decide for themselves which of the issues they wish to target in this cascade waterfall sell down event. But that's only if they think that the waterfall is out of place. And let's talk about that for a moment. Let's look at the GDXJ. And remember, we opened this video with the notion that mining shares are signaling lower prices ahead for gold and silver. Well, the mining shares are certainly signaling that. So why are we willing to game the miners now? Well, the simple answer is, as many of you have probably already guessed, the mining shares are not the only signals and indicators we track here at Gut Gold Report. This is the combined commercial net short positioning for gold. And if precious metals are set to plunge just ahead, not a little plunge, down to where we mark big support, but a deal-killing, bull market-ending waterfall, then why aren't the big hedgers piling on the short side of gold in preparation for it? Notice that as gold has pulled back, the big hedgers have also cut way down on their net short positioning. Let's look at the numbers. Now, this is the large commercials section of the combined COT. Notice that back on March the 20th, they had gotten down to 166,000 and change contracts net short, and now they're only 176,000 contracts net short. They actually increased their net short positioning by 5,000 contracts, which isn't very much this past week. But notice where that is in relation to where they were when gold was $1,783. They were at 245,000 contracts net short. So they have greatly reduced their net short positioning as the open interest has continued to fall. Now, falling open interest is typically bearish for gold. This is the commercial net short percentage relative to the open interest. And the thing to remember from this chart as we go forward is that the people that are in charge of hedging gold forward are not being very aggressive. In other words, they're not up to a high percentage of the open interest like they were when gold was near a recent high, like here and here. And so they're not being aggressive on the sell side of gold right now. It's kind of the same story with silver. Here the large commercials have gotten back down to about 26,500 contracts net short, with silver at $31.67. But the most interesting thing about this table, over here you see that the commercial net short position, that's the combined commercial net short position, as a percentage of the total open has fallen to a pretty bullish looking 21.8%. Now let's take a look at the LC&S chart. If silver is heading back to the low 20s or even lower, as one cocky and irresponsible fund advising manager / analyst who shall remain nameless on anything we do, he's out there saying that anyway. If silver is teetering on the brink of a big swoon, then why aren't the people who have to hedge inventory and metal in storage and metal on order or metal for delivery, metal backing up a boxcar full of derivatives and so on, how come the big hedgers are not, repeat, not building up heavier and more meaningful hedges? They're not. As silver has come off, so has their net short positioning. If they think silver is getting ready to fall off the delivery truck and smash to smithereens, they're not positioning for it, at least not in futures. Now hold that thought, because we've run out of time for part 1. We're going to stop here and pick it up with part 2.